Welcome to the Business of Property podcast. I'm Simon.
I'm Stuart.
And I'm Simon.
We talk every week about the reality of running property businesses. Stuart runs a portfolio of co-living properties with a six-figure turnover.
And Simon owns Buy-to-Lets and created Patma, a leading portfolio management software system and a source of property market insights.
And our guest today, Simon Glastonbury, is an independent mortgage broker with 25 years experience providing mortgages, bridging and development finance for home buyers and investors. Before we get started on our mortgage talk today, please do pop into the show notes, find the link to our email list and pop your details in there and subscribe. And we will send you interesting information about the property market and other things. Now, at the time of recording, just over a week, and at the time of release, nearly 2 weeks ago, that the Bank of England reviewed their base rate and they put it up again. So I'm guessing that with base rates going so high now, you're still really quiet in your business, Simon, and everyone is just scared stiff of taking out mortgages. Is that right?
Absolutely, of course it is, guys. Yes, good to speak to you and come on again. No, strangely enough, things have gone very, very busy for us, which is obviously good news on our part. Whether that's a case of people now getting used to the new rates, the sort of 4%, 4.5% rates which are out there at the moment are becoming the new norm. People are realising that it's not going to change anytime soon. And obviously with the Bank of England base rate going up yet again, they're concerned that it's going to continue to rise. Obviously, the impression is that it's possibly going to go up again, another 0.25%. So with that in mind, people are coming over to us and basically saying, right, okay, we need to do something now before anything changes. There's certainly a sort of worry in the marketplace, or a concern, that do you go for 2 year, do you go for 5 year? That's the key. That's the key in the market. Lots and lots of people at the moment are a 1 to 2 year rates. Rates are coming down in 2 years, or they're coming down again in 18 months. I'll refix then when they're back down to 2-3%. Frustrating on our part because we look at swap rates quite closely. We want to monitor the market, make sure we give the clients the best advice. And there is nothing out there at all, certainly from we can see and from the banks, to suggest that rates are coming down to that level in 2 years. So everything, the fixed rates are, the banks are factoring in these rate rises. And certainly from my feeling is that this is what we have for some considerable time. Sorry, that's very broad, but I mean, you're looking, I would say the next 3-4 years, this is where rates are going to be. Now, anything, I'll put a caveat in there, anything can happen. We know that around the world that can disrupt our sort of financial markets. But if things do stay as they are, I cannot see from what we're being told that rates are coming down anytime soon.
Yeah, it's interesting to hear that. And I will just quickly apply the caveat. As everybody knows, anything we say on this podcast cannot be constituted as financial advice. It's not what we do. We are just chatting, as we say on our preamble there. So, but it is interesting, Simon, that the general perception is, because we think, well, it's gone up, it must come down. But then if you look back at the rates, the Bank of England rates across the last 20 years, they were flat for so long. I mean, so long until just over a year ago when they just started going up astronomically. So I think what you're saying makes sense, because if they stayed flat at a low rate for so long, quite possible that they could stay flat at 5% for a number of years, couldn't they?
Absolutely. And I would go along with that, Stuart, most definitely. I think this is where we are, and it will be for some time. I think the concern is, certainly when rates started to go up, it seemed to be like, jungle drums. People were saying, and they want the rates to come down. So if they talk about it enough, and they talk about it over a pint or over a glass of wine or over a coffee, they're thinking, well, no, rates have come back down. It really does seem to be that's where these rumours are coming from. Nothing at all to support it. And you're right. You look back historically And rates do flatten out for quite a period of time when they get to a sort of comfortable, he says, comfortable position. And I think that's kind of where we are now. It'd be very dangerous for rates to go, certainly within the marketplace with the cost of living, to go very much higher. I think that was certainly, from having my feet on the ground and speaking to people about affordability and remortgaging, that would be a concern. I would certainly, as a broker, start being very concerned if rates went up to the 7-8% mark, let's say, just for an example, because an awful lot of my clients would be in a lot of trouble because they literally physically could not afford the mortgage. If people are PAYE, they have a set amount of income per month. Yes, and it would just take up every spare penny they had and more, and therefore it would just get them in trouble. So I'm sure Bank of England, etc., have this in the back of their mind when looking at these things. I think at the moment, this is where it is. I think certainly going back, if you're a first-time buyer, you've had a mortgage, in the last 12 years, you've had very, very low interest rates. And it's very, and we forget, if we've had mortgages for many years, unfortunately, and we know these rates, we've seen these before. So we can be kind of used to them. But if you've been a first-time buyer and you're just used to 2%, 1.5%, and then it's jumped up to, here we go, here's a 4.5% rate. How do you feel about that? It's a concern. But again, it's only a concern the first time you renew. Then you're very used to it. Unfortunately, they won't be able to renew, as I see all the time, they won't be able to renew their car for the third time in 5 years.
I'm intrigued by that, actually. You mentioned you're busy at the moment with people who are sort of accepting the new normal and wanting to actually start doing mortgage transactions again. I'm interested, are they actually having success, or is it still difficult to find mortgages that fit people's scenarios, as in allow a high enough loan to value, for example, given the situation they're in?
Yeah, I mean, the stress testing has definitely changed with the lenders. They know that but equally they still have to lend money. They're a business at the end of the day. We have certainly become busier with people. I think people have been holding off. Right, what happens? Are those rumours true? Will they start dropping? Will rates? Is it just a knee-jerk reaction from lenders? Also, the purchase market. Out of the let me give you a for example, out of the list of sort of general sort of business we do, the purchase market has picked up, strangely enough, in the higher price bracket, and people are fighting over properties if it's in a bracket of £1 million and above. That's what we're seeing at the moment, and we're seeing across the business, which is really strange. But you can, if you're looking for a property, 250, 300, and that sort of range, first time buyer sort of range, you can put a bid in and you can knock them down. Very peculiar, not something we've seen, and that's not particularly just in the southeast where we're based. Got clients all over the country, and it's sort of fairly standard, which is very unusual. Remortgage side, I think people are coming back. They've been holding off, waiting for rates, seeing what's happening. Can I get a better rate? Will it get any lower? And then the one market which has gone really quiet is buy-to-lets in a personal name, because the stress testing is very difficult now. It's completely changed. I mean, I looked at only yesterday, and the client had to put nearly 50% down as a deposit. Now, as an investment, if you're not a professional landlord, and even if you are a professional landlord, do you really want to put 50% as a deposit in? That's a lot of money when you're used to, over the years, only he says, but only putting in 25 or 15 if you're in a limited company. So limited company buy-to-let still buoyant. Limited company buy-to-let remortgages buoyant. That market's quite good. HMO market is pretty healthy. But it'd be interesting to see as the year goes on, or we go into the following year, how that buy-to-let market, because the banks have to lend. I have to remember this. So they have to come up with a product or something to make it a sort of feasible for the man on the street, lady on the street, to make it interesting and to get that type of product.
Well, it's really interesting because HMO investors, number one, myself being one, we're used to 5% plus. So number one, that the rates haven't necessarily scared me. It doesn't mean they're good, but we've been having around 5. It's been anywhere between sort of 4.5 and 5.29, to be honest, certainly from our friends at Kent Reliance. But obviously, if you're a buy-to-let investor, going from a couple of percent-ish to 5% is a massive change. So also there's not just the reality of those percentage points, but also the mindset of I'm going to have to pay this much and that's put much more in. And just before we get into the sort of meat and potatoes of some of the stuff that we're doing, and we're going to talk about the 100% mortgage, I was just interested to know anecdotally, so you said you're a lot busier. Have you heard from many investors that as a result of this and other stuff that we talk about on this podcast a lot, but just people just saying, that's me done, I'm either going to sell up or just move out of this as an investment strategy?
I was expecting so. I mean, they're not stopping looking at property. I think property is more difficult to come by. That's a certainty. I think any of the portfolio landlords I deal with, if they have smaller property, so which with the rental income has then gone, like you said, Stuart, you're going from you had a fantastic rate a few years ago at 1.5% up to 2%. And now you're looking at a rate switch with one of the lenders. A lot of the time you can only rate switch. Haven't got a choice because of the new stress testing, you can't remortgage your way and get the best rates on the market. Simply can't. So you can only rate switch. The lenders clearly know that. So the rates, let's just say, are not as attractive. So you can be going from, I had one just yesterday, going from 1.69 to 4.69. Ouch. All of a sudden, from making a nice little profit and were on the monthly, the rental, to now having to pay towards it. Now, if you're in that situation, now this is just a one-off landlord who has a couple of properties, but if you're a portfolio landlord, why would you keep it? I mean, that's okay. It's a long-term investment. Let's all be very aware of that. We know that, but how long do you keep it? If you're working on cash flow, as we've talked about before, guys, the cash is king. So, do you want to just keep that going for maybe 3 years, maybe 5 years, maybe longer, and you have to be putting in? It's kind of irrelevant, the amount. Maybe it's £100, maybe it's £500, maybe it's more, but that's a big dent into your cash flow, and for what? So, a long way round, Stuart. Circling back, it's yes. What they're looking at is it seems to be the smaller properties with the poorer rental yield they will want to get rid of. So my view there is that should then push those onto the market for the first-time buyers, because they're the types of property. Generally, if it's a 2-bed, 3-bed, 4-bed family home or HMO, they'll sell that anyway. That's not the issue. And the rental yields are so much better, generally speaking. But the smaller flats, plus you've got service charges and ground rents, etc., just doesn't make any sense.
Yeah, and I guess that's kind of what, if that happens, that's what the government and most of us would want, because you want people to have properties that need them. And on first-time buyers, I guess that leads us quite nicely and naturally into the 100% mortgage, because I guess that's who that was targeted at. And it is a hot topic, and you got some interesting views to share on that, because obviously everyone's talking about it and thinking that we're going to get into 24-hour express mortgages again, but that might not be the case, Simon.
No, not quite. I mean, I think it came out, for people who have been on Mars for the last sort of couple of weeks, Skipton released a track record mortgage, they called it, which in essence is 100% mortgage. Now, and I've had lots of phone calls, relatively, the phone wasn't ringing off the hook, but relatively, we had lots of calls. Can I get one? Can I get one? This is it. So hats off to Skipton. Great marketing, absolutely brilliant. I mean, whoever came up with, really thought that bring this back into the market is kudos to them, really. But it's a quick overview. You have to, it's first time buyers only. So you can never have had a mortgage before or a property. And, you've got to be squeaky clean. You can borrow, it's quite good. You can borrow up to 600 grand. Can't be a new build flat. And you have to have proof of having paid 12 months rent in a row during the last 18 months and have experience of paying household bills. So that's in the nuts of it, nuts and bolts of what the actual criteria is. So, of course, what I had is people who already had a property or they've got buy-to-lets and they're in rented and can I do this? No, you can't have a mortgage. You can't have buy-to-lets in the background. It's quite restricted. But, of course, again, well done, Skipton. I don't say that very much about lenders because we beat them with a stick all the time. But well done for coming out with something like this, because personally, I think I get shouted down quite a bit about this. Personally, I think the 100% mortgage for the right person is a fantastic product, especially in this, for the first time buyer in this market. If you have a very good, I'd say, secure job, what job is secure? But, if you've come out of university with, for example, with good qualifications, you've gone, you've been headhunted into a city job on a good salary, the likelihood is, it's all a gamble, isn't it, from a lender's point of view? The likelihood is that if you lose your job, you're going to have something very good on your CV. You'll get another one. So they're sort of edging their bets on this one. And I think for the right people, and they're looking for that, I think they're looking for that young professional going in, looking in London, Manchester, where the property prices are high, and getting a deposit when they've got huge student loans is just nigh impossible, especially when you're paying £1,500 a room for each month. Saving up is just, it's just beyond difficult.
The final thing I'll say on that is that I thought exactly the same when they were talking about it on the mainstream news, every half an hour or every hour. I thought, well done, Skipton. Well done, because number one, you've got your PR. Skipton's being mentioned at a national level. And, number two, for those that go to you and make those calls to you about can we get the 100%? Well, no, you can't. But here we've got another product you might like. So I think all round it was a good move from Skipton.
Absolutely, I think they've won all round. I mean, literally everybody's talking about it. And if it makes when's a new mortgage product in the last dozen years hit the headlines? I mean, they're hitting the headlines for all the wrong reasons. Interest rates are going up. Bank of England putting rates up. How are we ever going to survive? This is a kind of good news story coming in saying, look, we're friendly. We really want to lend to you. It is restricted, but hopefully others will follow. Unfortunately, we still have in the back of our minds the Northern Rocks of the world where when they used to lend 120%, which was, you look back and sort of shake and shiver and thinking, oh my God, how did that ever happen? But like I say, I think it's a fantastic product for the right person. And if it's underwritten properly, you meet the criteria strict enough. I think they should do quite well, but you've just got to tick all the boxes.
I'm intrigued by that criteria you mentioned, where you have to have experience paying household bills. That basically means you can't move out of an HMO room into a 100% mortgage. I mean, it means you're going to have to be coming from a buy-to-let situation, which I imagine must be difficult for sort of city dwellers and things, more so than people elsewhere.
But you can still pay household bills if you're in an HMO.
You mostly don't, though, do you?
I would say. I mean, it says right here the criteria, guys. It says this is on the from Skipton. Everybody can see this. You must have but also have experience of paying household bills, e.g., utility bills, council tax, etc., for at least 12 months in a row during the last 18 months. So I would say, most of you're not going to go. The likelihood you're not going to go from a student let into buying this straight away because it's just too soon. So that's where I'm saying you might go into a flat share, a room. And I would say if you can prove you were paying towards the bills, so then possibly, if you've got 3, 4, 5 people and you are contributing towards those, you would think that would justify the criteria. It doesn't say any more than that. It just says experience of paying household bills.
Yeah.
So how they read in between that. But again, Simon, like you say, so many people now are getting jobs, and certainly in sort of inner cities, use London, for example, and flats are just ridiculously expensive. You're not going to come out first job and get a flat on your own in central London. There are more and more, certainly I'm coming across more and more people who flat share, just get a room, and even those are expensive. So you would like to think they would be sort of fairly flexible on that.
Yeah, and as you say, sort of flat sharing, that is a general situation where you probably would be contributing towards the bills, as opposed to a traditional HMO setup where bills would generally be included. So yeah, I hadn't thought about the sort of sharing approach.
Yeah.
So moving on, and we're going to move on to the rates shortly. The other thing that you mentioned before we hit the record button, Simon, was around sort of more adverse lenders appearing in the market, and I find that quite interesting because when we think about the indicators, and people want to talk about recessions and stuff like that, which we haven't officially hit yet. But you talked about more adverse lenders. Tell us a little bit more about what you're seeing.
Well, this is adverse lenders came back on the market. Very rough figures, but probably 5-6 years ago, they started creeping in a little bit more, becoming more popular. So if you had things like defaults, CCJs, old bankruptcies, even IVAs, lenders would come back into the market, and the rates weren't particularly scary. Obviously, compared to your standard rate, historically 2-3% above what you would normally expect to pay. But obviously, these are people who've missed a number of mortgage payments, they've missed a number of credit card payments, they've got the CCJs for whatever reason. I think, and we're certainly seeing more on the market at the moment. Now, I'm not an expert in this field by all means, and there will be other people who certainly are, but I mean, I certainly keep my ear to the ground on these things because it comes up every now and then. And I think, again, it's something that lenders realise they need to get back into the market, because with the cost of living crisis we're in at the moment, with COVID, which is still it's only just happened. People are certainly self-employed who didn't go on furlough. A lot of self-employed people I've seen accounts over that period, income has dropped massively. Then they weren't able to pay. They had a few months off on mortgages and holidays. They were quite generous, but they were also quite strict. You think in the number of lockdowns and what we had to go through. All sorts of businesses really suffered. So their credit cards were maxed out. They weren't able to meet them on time. So people like that, they will now look in, and the rates are not particularly scary compared to, like I say, they can be one, depending on how severe the adverse is. I don't think we'll go quite back to sort of 2007, 2008, when literally you could have not paid anything for the last 6 months, 12 months, and you would have still got a mortgage of about 1% higher. But I think, thankfully, we won't go back to those days. But now rates are there. Lenders are, again, looking at angles to say, right, we've got this here. We understand people are having problems. And I think certainly going forward, more people will be looking at adverse rates. I think a lot of these people, what I've noticed is over the last sort of few years, is it's people who've just been sitting on standard variable for a very long time. So they had a fixed rate back in 2009, 2010, sat on a 5-year rate. And then by the time they came off that, standard variable rate could have been 1.5%, 2.5%. So they haven't needed to fix. But in that time, they've got themselves in a bit of trouble, missed the odd payment here and there, and now need to do something because rates have gone up. So all of it, their standard variable is no longer attractive. That's quite, speaking to different people, that's a fairly commonplace. There's still an awful lot of people in the country just stuck on standard variable and can't move.
Cool. Thanks for that. So I guess we should, as we're nearing the end of our episode, just talk about what rates people can look for, what's good for limited companies and buy-to-let, Simon. So if you're able to share that with us.
Yeah, absolutely. Rates, a quick sort of overview on the residential market this goes on both sides, actually. Just a reminder for people that 5-year rates are still cheaper than 2-year rates in the majority. There's always going to be one here and there. So again, as you said, caveat that, but this isn't advice, but it's in the norm. 5-year rates are residential are a touch over 4%. 2-year rates about 4.5%. So, which is, again, very peculiar. If that gives you any indication that what's going to happen with rates in the future, you can read into that what you will. Certainly on the buy-to-let side, you're looking, as we said, Stuart, before, you're looking around about the 5.25% mark on both, and that's on a 5-year rate, and it'll be slightly higher again on the 2-year rate. Now, so if you're looking on a limited company, you're looking on a buy-to-let, you're looking at around about 5.25. Now that then we touched on it a little bit earlier about arrangement fees. That will depend on arrangement fee. So you'll get a better rate if you want to pay a high fee. I mean, for example, Fleet at the moment are offering a very nice 88-month. I'm quite sure where they got 88 months from. An 88-month, 4.99% fixed. If your EPC is, I believe, A or B, they call it one of their green mortgages, which again is not something we've come across before, talked about before, but maybe we can at another time. So if your EPC is A or B, they'll give you 4.99 for 89 months, but it comes with a £7,500 fee.
Wow. Whew.
So, that's based on a £300,000 mortgage.
That's why it's a green mortgage, because of all the money they're taking off you. They're taking all of the notes.
Yeah. No, sorry. That's not a percentage. That is a flat fee.
Yeah. Yeah.
So that could work for very expensive properties.
Very expensive. Yes, absolutely. And let me just have a quick look. That's the type of thing they're looking at. I mean, are they going to sell a lot of those? I mean, you can go borrowing up to 5 million with that, but how many limited company buy-to-lets are at 5 million? They don't come across my desk all that often. But then look, the mortgage works. TMW, very aggressive in the marketplace. They're always looking at new products, new angles. Their range of arrangement fees are quite vast at the moment. They go from 3% down to 0. And so, again, an example, limited company buy-to-let, 5.49% at the moment for 5 years, 0 fee. Okay? But if you want to pay 3%, it's 4.89. And again, Stuart, we discussed before, you've got to crunch the numbers with your particular mortgage. And that's where I'd say, this is where we come into it a lot. We'd speak to, we'll talk to you, we'll talk to people, we'll say, right, okay, here are the options. So at least you have them in front of you. The fee might be very high, but it might suit you for that particular property. It does frighten a lot of people off as soon as you start talking about 3% fees, and rightly so. It's huge, but it might suit you. Yeah, for that particular, you might be looking to do something particular with that property.
Yeah, I mean, just quickly in real terms, I mean, if you think about the average UK house price, just as a for instance, I mean, it's around 300k. Let's just say that it's fluctuated, but let's say 300k. But that alone is £9,000, and that is why, and of course, you're going to get properties for a lot less, and you're going to get properties for more. But as an average, that's significant.
Yeah, it's huge. It really is. I mean, I'm looking. Yeah, you're actually right. I'm looking at one. I've just put some figures in here. Just over 11 grand for a £500,000 property, which is, certainly in the southeast is. I mean, you guys know. You're looking at property prices. You don't flinch, do you, at a property price of $500,000, which is ridiculous. Really, it's a huge amount of money. But you just don't even. You go, oh right, okay, that's $500,000, as if it's just if it's paper money. But it's a lot. And if you actually look at it, the nuts and bolts, that's £11,000 just for the arrangement fee. Yeah, it's fixed for 5 years, so you can spread the cost. You can look at it spreading the cost over that term. But this is where it is, to just say to everybody, speak to a broker, look at all the options, because the lenders are certainly, we're noticing this more. They're trying to fight for market share. They're trying to come up with new ideas, and what they're doing is certainly like to TMW are really aggressive with the difference between fixed arrangement fees, which is usually 1,495, 3%. Then 0, and they change those around whenever they need to.
It's a bit like, it's for some reason, and because I suppose the kind of like the silver bullet is they say add it to the loan. So immediately, it's not like real money, is it? It's a bit like when you go airside and you're going on holiday and you're in the shops. It's not real money, is it? You spend the money and it's just not, it's just free money, isn't it? You're not actually spending money, and it's a bit like that because the banks fooled you into saying, well, we'll add it to the loan so you don't have to worry about it. But of course, it's being paid for. Someone's got to pay for it.
Absolutely. I think that is such a good point. And we as brokers fall into that trap, because the first thing we say, and I'd argue any broker who doesn't, is that you say, don't worry, you can add it to the loan. And as if to say, oh, well, thank you. Brilliant. I don't have to pay it. Well, of course you do. You're still paying that money. You're adding it to the loan, and 11 grand, you're then paying the interest on that 11,000.
And that's the point, the interest. You're paying 5% on 11k per annum.
Absolutely. And it goes on. And that doesn't disappear after the 5 years when the 5-year fixed rate is up. That's then just bolted onto your mortgage. So your mortgage has then gone up by £11,000 on that particular deal. So then you're paying that for it, and then you remortgage again in 5 years' time, and you have another however much. I mean, who knows where we're going to be then? And then you're paying interest on that again. So it's a really, really good point. It is a bit of a carrot that, okay, you can add it to the loan, so you don't have to see it. I mean, I am seeing, it's interesting actually. I have, and whether it's just a period I'm going through at the moment where people are paying fees up front because they're very aware that they don't want to pay interest on it over the period of time, which is fine. But it's quite funny that you then go to the lender and say, I'd actually like to pay this up front. And most lenders go, oh, really? I'm not sure we can do that, because it just doesn't happen. It's very, very rare that people will pay.
You've got a customer that wants to be financially responsible, Simon. No, we don't want to deal with them. We don't want any of them.
Absolutely. Yeah, I'm completely flustered by that. I have to have a sit down in another Starbucks.
Right, well, I think we're about out of time. So thank you very much, Simon Glastonbury, for joining us. To everyone listening, if you would like to get in touch with Simon, contact details for him will be in the show notes. So please do reach out if you have any mortgage questions. And other than that, Stuart and I will talk to you again next week.